All right. Well, hello and welcome, folks, to another Tuesday midday talking about how to get access to business funding. And today's really exciting because we're going to be talking about securities-based lines of credit. So, how do you actually go about using your stocks, your bonds, any types of investment securities that you have and attaching that as collateral in order to get loans and lines of credit. This is really, really exciting. And this is one of those things that it was a little bit tricky at the beginning of the entire pandemic situation, but we are now seeing that this is a truly viable way to get funding in today's market. And so let's dive into really what is securities-based lending. The term securities-based lending, or SBL for short, refers to the practice of making loans without security or with using securities as collaterals. Now, securities-based lending provides ready access to capital. This is super quick money. Sometimes this can be found in as little as 72 hours. So this can be used for almost any purpose. There's a lot of times that certain lending products have restrictions. And now there is one restriction. We'll cover that in just a minute, but you could use this for saying buying real estate, investing into a business. The only restriction to this kind of lending are using it to acquire other securities, using this for security-based transactions like buying shares or repaying a margin loan. So you can't use it for anything like that. Now, generally, this is offered through large financial institution, private banks. This is used many times to get access to a lot of capital. People tend to seek out securities-based loans if they want to make large business acquisitions or if they want to execute large transactions like real estate purchases. But really, for anything that you're trying to do, you can pretty much use this funding. And we're going to dive into why it's so good, but you don't actually have to get rid of your securities, your stocks, your bonds. You don't have to get rid of that. And those can continue to grow as you use this type of funding. They're literally just the collateral for the loan or the line of credit. Now, how does this process work? So lenders will determine the value of the loan or the line of credit based on your investment portfolio or what you're actually willing to put up for collateral. So in some cases, the issuer of the loan may determine your eligibility based on the underlying asset. Like, let's say that they're valuing your stocks and your bonds at $50,000, then they're going to look at that as their guarantee in case you were to default. Can end up approving a loan based on the portfolio of the U.S. Treasury notes rather than stocks. So, of course, depending on what stocks are they evaluated at a little bit higher risk, then they may not loan you as much. U.S. Treasury notes are pretty much the most secure vessel, and so those are a lot better, but everything in between. Let's say that you have, and we're going to go over exactly what types of securities you can use, as far as mutual funds and all that later in today's presentation. So the whole process, once you're approved, your securities or the borrower's securities, quote unquote, the collateral, are deposited into an account. The lender becomes a lien holder on that account. If the borrower defaults, so if you were to default on the loan repayment or the credit payments, then the lender can seize those securities and then really use those as collateral by selling those off and recoup any losses or try to mitigate any losses that they have. In general, borrowers can get cash in just a few days. Like we mentioned, sometimes 72 hours. It can actually happen really, really quickly. Securities-based lending is also relatively cheap because they have a security attached to it. Interest rates, fees for starting these types of funding are absolutely beneficial to you and in your favor because they're secured versus unsecured financing. Us here at Wise Guys and Ties, we don't actually charge you anything to help you find these. We actually receive a referral fee when we connect you to these lending products. So you actually can use our services free of charge, which is called our financial blueprint. And we can take a look at your situation, look at what stocks or bonds that you have, or somebody that maybe is a family member or willing to put their securities up for a guarantee for you to get some funding. And then we can look at that, we'll evaluate that, and we'll help you find a lender that will work good for you. Now, the rate borrowers are charged is generally variable based on a 30-day London Interbank offered rate, so the LIBOR. Now, I'm not going to go into the LIBOR today. That's a whole nother video in its own, but you could Google that and kind of see where that's at. But we will make a video on that in the upcoming weeks. But what is LIBOR? Its interest rates are typically 2 to 5% points above LIBOR. And depending on the sum, LIBOR is derived from the average of daily self estimates of borrowing costs. So this is kind of a rule of thumb for interest rates supplied by a small group of large global banks. It's a way for them to really control interest rates at the very base of what it is. All right. So advantages of security-based lines of credit, getting access to cash when you need it. I mean, like we said earlier, this is really, really quick. It moves quick. So you can potentially avoid capital gains taxes from selling your securities. As we mentioned, we're not selling the securities. So when you have somebody that you may be thinking, oh, I don't have any stocks or bonds or anything like that. Well, maybe you know somebody that has stocks or bonds that would be willing to put those up as collateral. And the only way that they would lose that is if the repayment was to lapse and you were to default on that repayment. So they don't have to, let's say that you going to your father or something like that and say, hey, I need a $20,000 investment. Well, instead of having all those tax disadvantages by cashing out those stocks and bonds, looking at potential capital gains, you can keep those stocks and bonds growing and just using those as collateral, which is a very, very powerful tool, then taking those funds to go out and generate wealth. Typically lower rates than other forms of credit, like we said, no setup, non-use or cancellation fees, the ability to borrow a significant percentage of your eligible assets, depending on what type of collateral and type of credit that you're receiving. So certain loans are going to have a higher loan to value, certain lines of credit, and then that also is directly correlated to the risk of the security that you're putting up as collateral. But like I said, reach out to us. We can take a look at what you have and give you a good idea of what you'd be looking at if you wanted to go down this route of funding. So the SBL offers access to cash within just a couple days at lower interest rates with considerable repayment flexibility. Sometimes this could be daily, weekly, monthly, lump sums. There's a lot of different options here. These rates are often much lower than home equity lines of credit or HELOCs or second mortgages. So we talk about HELOCs and being really good products. These are actually even better rates than that. Also, it works best when you used for short periods of time in situations that demand a significant amount of cash quickly, like an emergency or a bridge loan. That's really when this works really well. So some other advantages to using of security-based lines of credit. This also provides benefits to the lender. If you're a lender, you want some security. You want to be reassured that your investment is safe. So it offers an additional and lucrative income stream without much additional risk. The liquidity of the security is used as the collateral, and it can help mitigate much of the credit risk associated with traditional lending. You can find out more by going over to investopedia.com and check out some of the security-based lending information that they have. A lot of good content over there. More advantages of securities-based lines of credit: you can stay invested. You can also keep your investment plan and asset allocation in place. You don't have to move anything around. You don't have to take any withdrawals, and you're not going to be disrupting any type of market investment strategy that you're already partaking in. There is financial flexibility and other bonuses and benefits to that. And you can quickly access liquidity for a range of uses. Now, one thing that we mentioned earlier, these have to be free and clear securities. They can't already be margined. They can't have any other type of encumbrances against them. So they have to be pretty much free and clear, that you own them. There's no other liens against it, as is any securities-based lending product. When you have an asset that already has a loan or a lien against it, it gets a lot harder to add another loan or lien against that asset. Same thing here. And so there's some disadvantages of using security-based lines of credit. You are putting those securities up as collateral, so you have those at risk. There's a value that is affected by events outside your control. So if the stocks or the values of these fall, then you are at risk of having part of that line reduced or having some of it called due. Market fluctuations may cause the value of those assets to decline. Hey, what's up, Dwayne? Good to see you, buddy. Tuning in on YouTube there. And folks, if you're tuning in to us on YouTube, you can actually go over to wiseguysandties.com and under the events tab, plug into all of our free weekly Zoom webinars, and you can come right into the webinar here as well and be able to ask any and all questions that you wish. So back to some of these disadvantages. A decline in the value of your securities could result in a selling of your securities to maintain that equity. So let's say that we have $50,000 in stocks that we have used as collateral. All of a sudden, there's a shift in the market, and we lose, 10% of that value. So all of a sudden, now our collateral is only worth 45,000. In that case, they could reduce the line of credit or the loan or ask for a certain amount to be paid back. Most likely what this would look like is a loan limit being reduced to mitigate that risk. Because remember, this is collateralized. So if the collateral falls, then that's going to set off a chain of events that could reduce that line of credit or, start to have certain aspects of that being required for immediate payback. So a risk there, but of course there's risk in every situation. That's why we say we like using these products for short terms. That way you can kind of mitigate some of that risk on your own. Now, a decline in the value of your actually, we already kind of touched on that, but you may suffer adverse tax consequences if, for example, you had to sell off some of those securities to pay back some of that line of credit or in the event that the values fell. So there could be some tax issues that go along with that. That could be a disadvantage. Now, security-based lending, the growing usage of that has led to a concern with some banks because a lot of funding and different things in this period of time have started to become a little bit more restricted. And this is one of those things that is still being widely used. So the systematic risk of this. Now, what does that mean? When the pandemic started this year, probably around March, that's when it really kind of was in full blown. We saw the stock market, crash. A lot of that has to do with, auto sell-offs, puts and calls, and there's a lot of automated trading. And so just the way that the system is now, we see a lot sharper crashes in the market, and downturns can go really quickly, but then also rebound very quickly. So there is a risk there. If you have some bonds, those are going to be a lot more secure, and you're not going to see credit lines getting cut as you might with just straight stocks. But of course, if you need funding, this is an amazing way to go because it is money and it can be accessed really quickly. All right. Dwayne says he just purchased the credit banking book. Very excited. Hey, good job, Dwayne. Yeah, folks, if you there's three things that Wise Guys and Ties help you out with. We help you out with business funding. We help you out with personal debt and getting out of that by understanding what's called credit banking, and then also investing in the real estate. And tonight we have another weekly episode of the Credit Banking Mastermind. You can tune in live on YouTube or join us through the Zoom call directly. And that is going to be kicking off at 6 p.m. Pacific Standard Time. And so we hope to see you all tonight. All right. So back to some other disadvantages of securities-based lines of credit. Securities-based lending is not tracked by the SEC, which is, that's a benefit. It's a benefit and a disadvantage at the same time. So it's not tracked by the Financial Industry Regulatory Authority, or the FINRA, as we like to usually refer to as. Still, both continually warn investors of the risks involved in this type of market and accessing collateral. Another risk is you are depending on your securities for your retirement funding. And so putting your stocks and bonds at risk, it may not be something that you're willing to do. But remember, the only way to really lose it is if you were to default on those payments. So as long as you were able to maintain those payments, then you're not going to be in risk of losing it. And if they lose considerable valuable during the life of the loan, that could be another big issue as well. All right, so some other disadvantages. When equity and fixed income markets perform poorly, that happens quite frequently. The market value of many assets can hit low levels that weren't previously unthinkable, like we mentioned earlier. The market value of many assets can hit lower levels. And let's see, unless the borrower has a lot of surplus liquidity beyond the securities, backing of the loan or other securities backing of the loan consists of almost entirely of the assets like short-term US Treasury bills. This could result in the bank calling the investor's collateral due. So to put that in just an easy way to understand, that as whoever the underwriting bank is on this loan, they need to make sure that they're going to get paid. And if the stocks crash, then they're going to have the right to call that debt due immediately. This actually is true with any line of credit, even your credit cards. The lender at any time has a right to call that due if they feel that the risk is too high. They have a right to increase or decrease the line of credit any time that they wish. That's just one of those things. And, we've seen that a lot happen this year where people on their personal credit have been hacked or closed without even notice. Sometimes they'll give you a notice saying, if you don't use this card, then you're going to be closed. But we've seen closures and things like that with no warning. But that's a risk that you're going to take with any type of line of credit or loan. It just is something across the board that could happen. All right. So a few other disadvantages: bank calling and the investor's collateral could trigger forced liquidation of those securities. And if you're having to sell those at, when the prices are low, that's really not the best situation because you want to buy low and sell high. So if you're forced to sell when it's low, that could be a double whammy. And in such cases, the borrower does not have the option to buy and hold. In that situation, they don't have the choice of waiting for the market to recover. All right, so when equity and fixed income markets, let's go, we already talked about some of that. Let's talk about which sorts of securities could be used with this type of lending. So marginable equity securities, ETFs, usually what those are referred to, exchange traded funds, most mutual funds, cash or cash equivalents, CDs, certificate of deposits, fixed income investments. This could include most investment grade corporate treasury, municipal government agency bonds. So a wide variety of different types of securities, stocks, and bonds could be used for this. Our securities-based financing offers a powerful and flexible way for your new and existing businesses and franchises to gain access to capital. You can leverage those assets that are currently in stocks or bonds to get low interest rate credit lines, and happens very quickly, within 2 weeks typically. You can invest a portion of your stocks or bonds into your business without having to actually liquidate those stocks and bonds. This gives you more control over the performance of your retirement plan or assets, so you don't have to actually sell those off. And it gives you working capital that you need to grow your business. So some other securities-based line of credit details are: you can be approved for low interest credit line for as much as 90% of the value of that security. Most stocks and bonds are accepted. You keep all the interest and appreciation from those securities. There's no prepayment penalties. Your securities stay in your name. So these aren't actually transferring out of your name at all, which is good. So here's how to qualify for securities-based line of credit. Securities-based financing is very easy to qualify for. You won't need financials. I mean, good credit, or you don't even need good credit actually to get approved for this, which is really nice. So if your credit's not where it should be or where you think it should be, you can get access to this because you're using those as collateral. To qualify, all the lender will require is a copy of your most recent security statement. If your stocks or bonds have a value over $25,000, you can be approved. So you do need, you can't do this with just $1,000 of stocks. You need to have some actual stocks and bonds of significant value for it to be worth their time and energy to write this up. Even with severely challenged personal credit, we talked about that before. Terrible credit does not eliminate you from this because this is a collateral based product. So traditional financing, if you're going traditionally with the SBA, Small Business Administration for a loan, you're going to need all the big three that we usually say: credit, cash flow, and collateral. In this case, this is one of those things that you just need the collateral. Cash flow is not a big issue. In your personal credit and business credit is not a big issue with this funding. It's specifically going to be looking at the collateral that's being put up, which is great. I mean, that opens up a lot of options. And you may be thinking that you may have some credit issues now. So our securities-based finance program is perfect for business owners who have those credit issues. Lenders are not looking for, they don't require that good credit guarantee. Credit history is not important, except you can't have any bankruptcies or foreclosures in the last 5 years. Credit history is not used to determine the rate or the loan to value. This is one of the best and easiest business financing programs you can qualify for. You can get really good terms, even if you have severe credit issues. That's why I really like this option. And get that fast funding that you're looking for. To recap, securities-based lending included for lines of credit allows you to leverage those securities without having to sell them. The rates tend to be tied to the LIBOR, which is, kind of the interest rate control. And there are both advantages and disadvantages from this form of financing. Only you can choose if it's worth it. Now, of course, with uncertain economic times, there's always risk, but there's a lot of stocks out there. There's a lot of mutual funds that have consistently performed, and there's a lot of bonds that are very, very secure. So don't necessarily think that you're in or you're out at this point. Reach out to us. We have 27 different ways of looking at different options to finding capital, whether it's using credit, whether it's collateral, or it is cash flow. There's a lot of different options out there. And many times we will start with the easiest and quickest ones, but if you don't have anything that can qualify right now, maybe somebody can help you qualify for this. This is very easy to have somebody else use their personal credit or their assets or their collateral to help your business get funded. Over 70% of businesses have love money. So somebody who's a family member or a friend to help grow their business. So Wise Guys offers a security-based line of credit program, which can get up to 90% of the value of your holdings with very, very fast decisions. We can have this done in just a couple of days, knowing whether or not you're going to be able to move forward. Low rates, the ability to qualify for it, even if you have bad credit. Choosing to go for a security-based line of credit is a big step. It's a big step, but we can do this together for sure. And get access to every legitimate funding program all in one place when you work with the Wise Guys and Ties. Like we said, in this case, when we do a financial blueprint and we look to see what funding is available, you do not pay us fees. We work specifically on making referrals to these other lenders and secondary markets and things like that. And as we bring them business, they will give us kickback. That's how our team gets paid. So use our loan volume and our referral reference network to get the lowest rates and fees. Our business blueprint going through this process and then graduating to SBA loans. It's a whole process when you start working with our team. And the hope is that you never have to go somewhere else to look for funding again. So that concludes our securities-based lines of credit training for today. For more information, reach out to us, 888-524-9273. Email us at bizcredit@wiseguysandties.com, or go over to wiseguysandties.com, where you can find out more about building business credit and different access or ways to access business funding. Other than that, we look forward to seeing you tonight for another episode of Credit Banking in the Search for the Lost American Dream, where we will continue the journey to helping you understand your personal financial situation and helping you get out of debt. Thank you, everyone, for being here today. Good night, and God bless.